Well, welcome back to the Financial Pulse Radio Show. I'm your host, Danny Howes, CEO of East Coast Tax and Financial Planning. Welcome. You are listening to the Financial Pulse. And I just wanted to talk today about just the elephant in the room. You know, the market has been kind of all over the place over the last week and a half, 2 weeks. And we've seen some pretty major drops. In fact, the Dow saw its largest point drop ever recorded just in one day this week. So we've seen some sell-off, and that's caused a lot of nervousness, obviously. Caused a lot of people to take a double take. If you haven't been watching the news, you don't know about this, you really should. If you have a 401k, if you have an IRA or a brokerage account or savings accounts that are invested in the stock market, or variable annuities or variable universal life policies, anything that's tied to the stock market, if you have money there, you really should be taking a look at that on a regular basis and keep an eye out for the news. You know, it's not enough just to hire an investment firm and just kind of set it and forget it, or a broker that you trust. You really need to be involved personally, because when you are involved personally and you're educating yourself as much as you can and just really know the comfortability of where you feel good as far as how you're invested, that's going to help you sleep well at night. It's also going to help you make smart financial choices and decisions. But the more you're outside of it, the more you don't pay attention, the more that you're not checking your statements, even on a monthly basis. Go ahead, take a glance, take a look at, open up a website, Bloomberg.com or Morningstar or Yahoo Finance, and just kind of read some of the financial news of what's going on in the world, so that you don't wake up one day financially disappointed or even embarrassed. And that's what we've seen over the last major crashes, is that people just weren't paying attention. We become comfortably numb. We forget what it's like to stub our toe in the middle of the night. And then it starts to happen. And then it's like, oh, wow, what do we do? And it's late reaction. It's the lack of being proactive. Stephen Covey talks about be proactive. And you're probably really proactive at your job or the business that you're running and own. You may be really proactive at your education. If you're a professional, a scientist, a doctor, a teacher, whatever the case may be, you may be very good at your craft. But you got to remember that your craft and what you're working so hard for right now is to build that savings account, build those buckets of money, so that your future, that you can maintain the lifestyle that you desire well into your future, as you decide to stop working or rewiring instead of retiring, whatever the case may be, so you can make sure you don't outlive your money. And it sounds simple enough, but it's really easy to just kind of set it and forget it. And when we see a lot of the volatility creep back in, that's when we really want to kind of scratch our heads and say, okay, am I in the right place in case some things aren't necessarily going to go so right? And that's really what I'm talking about. If your portfolio is designed in such a way where you've already seen it, you've seen what it could have done maybe in a major correction like 2008 or the early 2000s, or in a rising interest rate environment, if you have a lot of fixed income in your portfolio, how would your portfolio react with big changes in the market, big swings one direction or another? And it's that risk versus reward question. And I kind of rephrase the question a little bit like this to help people think about that. And it's like this. So let's say you bring in $100,000, to make numbers simple, to invest in our firm. And we invest your money, we have your $100,000, we make 30% that first year. Now we're up to $130,000. The question is, do you change what you do? Do you change your mode of operation? Do you change your budget at home? Is it really going to change your life much if all of a sudden we made 30% return, really great return for you? Most people would say no, right? Most people would say, I'm happy with that 30% return. At least that's what most people tell me. I'm happy with a 30% return. That's more money towards my goals to make sure that I'm more secure. So in effect, they feel more secure because they made more money, but there's not really going to be a major change in habits or change in how they do things or how they spend their money. They're just happy that they're going to have more. It doesn't matter what your number is. If you got $1 million, 30%, $300,000, whatever it is. Now, we flip that conversation around. You work decades for, what you've accumulated and worked hard. Maybe you're close to retirement, almost retired. You bring $100,000 in, or you bring $1 million in, whatever that number is, and we lose 30%. We lose 30%. So now instead of $100,000, we've got $70,000. Now instead of $1 million, we have $700,000. Then the question is, would that rattle you? Would that change you emotionally? Would you be upset? And then also, would that maybe change your plans? Would you still feel like you had enough money to retire? Would you feel like you had to make up for a lot of lost ground now? Would you feel like you would need to do maybe a lifestyle diet where you have to trim down expenses, not go on those particular trips you were dreaming of, maybe not buying that house or the condo on the beach or whatever it is, or just we're going to have to tighten the budget at home because we know we're not going to be able to maintain at this current level. That's the risk versus reward question. And as you tighten that up, and you look at, say, 20% reward for maybe a 10% down, potential downward risk, we tighten that number up so that when we design a portfolio and we invest the money, we are tailoring it around what you feel comfortable with on the potential of the investments. Because everybody knows if you invest money in the stock market, there's a potential that there's going to be downturns. There's going to be times where it's going to be down, and there's going to be times where it's going to be up. And we try to live by the averages and invest our money so that our average rate of return meets our expectation without taking on more risk that our expectations can afford. And so that's really the question. That's the risk versus reward question that people should constantly be asking themselves, so that when your advisor, your stockbroker, or whoever, maybe even yourself, is investing the money, you need to make sure you're investing within that risk tolerance and that comfortability. And that all goes back into the investment policy statement of what am I going to do. I have a predetermined action I put together according to what goes on in the market or according to what goes on in our lives and so on and so forth, so that when these things come, we already know, oh, no, we don't need to react, or yes, this is kind of reaching my threshold of making an action, whether it's a buy action or a sell action or something like that, or your advisor is going to make a reallocation or change things to make it so that they're meeting your expectations. That's what that investment policy statement is all about, is to help you to get through these types of times so that when there is an event to trigger your reaction or your advisor's reaction to change a portfolio potentially, then it's already there. It's baked in. You already talked about it. You already thought about it. And that could still change. You could still change your mind on how that works. But having that in the forefront really gives you a good baseline going forward. It's not like deer in the headlights of, whoa, what do we do? White knuckling it all the way down if you see a major crash or that sort of thing, because you just don't know, because you're paralyzed, because you really haven't prepared yourself for these things. And I know these things sound really heavy. It's like, well, that's what I hire financial advisors to do, or somebody like our firm to do, right? But I'm just talking about getting involved in your money, regularly speaking to your financial advisor, regularly speaking to your accountants, and regularly speaking to maybe an insurance agent that sold you a growth type of product like an annuity or a cash value life insurance policy. It's amazing to me how many people come in, they're first-time people into our firm, prospective clients. Maybe they need an analysis done, they want a tax analysis done, or they want to know what's going on in their investments. And then we describe how we operate and what we do and how often we meet with our clients, communicate with our clients. And it's amazing to me how few phone calls or even visits, and sometimes it goes on for years, where there is no communication between the person that's managing your money and yourself. Like zero, maybe once a year phone call. And, there's bound to be some things that are surprises that can pop up as a result of that much lack of communication with the professionals that are in charge of your financial life, if you've got people that are managing money for you and so forth. If you've got a 401k, that doesn't mean you can't get professional advice on that 401k. Financial advisors can still advise you on your retirement plans at work and so on and so forth if you have employer retirement plans. So just because you're separated a little bit more from your money because it's an employer-sponsored plan like a 401k or 453 or 457 or 403b. Those type of plans still should be monitored and looked at on a regular basis so that you can be confident in where you're going. Well, just like every week, we are running out of time, but every single Thursday right here on Waxy Radio, 10:30 a.m., every single Thursday, East Coast Tax and Financial Planning. This is the Financial Pulse, and I am Danny Howes. Make sure you visit our website, eastcoasttaxandfinancial.com. Make sure you protect that money, folks, but make sure you know who and what you're protecting it from. We'll talk to you next week.